All right. Next up, we have navigating the risk of RWA tokenization. And on this panel, we have Sam from Steakhouse, Sydney from Maple Finance, Herbal from Huma Finance, Anthony from Trident, Chris from Plume, and moderating the panel, we have Flunkmasterflex.eth from Trueflation.
Hey everybody, ready to go on this next panel here. My name is David Garfunkel. I lead BD at Trueflation. We build uncensorable financial data. Prior to that, was working at Index Cooperative, building out structured products with some of the people here. We have a great panel talking about RWA tokenization risks. I'll do a quick intro for everyone here and then get started on some hopefully meaty topics. We have Sam from Steakhouse, an advisory firm focusing on Dow Treasuries, liquidity strategies, working with a lot of OGs in the space. So Sam right down there. We have Sydney Powell from Maple, founder of Maple. Maple's been OG in the on-chain credit space, building out a suite of products, public credit, private credit, all along the way. We have Herbal from the Huma Finance team, taking private credit on-chain, things like receivables finance, emerging market credit as well. Anthony here from Trident. Trident focuses on bridging off-chain liquidity, on-chain world, helping stablecoin adoption, secured yield, things like that. And then finally, Christian from Plume. Plume is building an L2, focused specifically on RWAs, so hopefully a space for people to build all the things we're talking about today. Very excited to be at Stable Summit. This is the third one. This is my second time speaking. Usually a good conference. Stablecoins are probably the first and arguably the only use case of crypto thus far. That might be controversial to say. But yeah, today we're talking specifically about tokenization, the risks involved, things like counterparty risk, market risk, liquidity risk, so we'll really get into all of it there. I'm going to start with the Steakhouse team. Quick question, just as we talk about some of the risks associated, I wanted to start with counterparty risk. You guys have done work with MakerDAO in the past, so was hoping to just try to get a better understanding and sort of tell the crowd here counterparty risk with things like DAI, how they're connected to the USDC and real-world assets like that. Meaty topic. Apologies.
Yeah.
Sam.
Well, as far as RWAs are concerned, counterparty risk is always a concern in terms of the credit of the borrower that is facing MakerDAO. MakerDAO I think really has two primary concerns when a vault is opened. It's the credit. Are you going to get paid back? And then the liquidity. The demand for DAI can be volatile depending on the day, and as that changes, it's really important for capital to be able to come back on chain efficiently and quickly. So even if an underlying asset may be extremely liquid, if the financial rails do not provide for the quick transfer of large amounts of cash, then that's going to create an issue for MakerDAO. So MakerDAO has about 2.2 billion of RWAs currently. About 1.8 of those are in treasuries, and then 400 million are in what we call private credit. So even if the short duration treasuries that make up the 1.8 billion are super liquid in traditional financial markets, being 6 months and less in duration, the actual ability to get it from the custodian through the banks, through the exchange agents, and back on chain when MakerDAO needs it urgently is a whole separate process, and that's something that we're very focused on as we build out this new phase of RWAs as people focus on the cash equivalent short-term yield.
Yeah, glad you brought up specifically short-term yield. Really, it seems like in the past few years, the emergence of private credit was pretty quick on-chain, and now many examples of public credit. Sydney, you guys do both at Maple. Would you be willing to explain maybe some of the differences in some of your guys' vaults and then how it's changed over the past few years?
Yeah, for sure. So Maple does a lot of institutional lending. Now, if we go back to 2021 and 2022, this was primarily private credit to market makers. So very, very crypto native, very short term in duration, higher yield. And this was in an environment where treasuries were basically paying 0 and on-chain loans were paying anywhere from 7 to 8 at the very low end up to like 13, 14. So quite a spread versus what you could get in traditional markets. Midway through, or mid to late 2022, treasury yields come right up. So people are very interested in risk-adjusted yields, particularly following the events with FTX and some of the other more notable collapses. And so then that meant that the strategies in Vault shifted towards more conservative kinds of private credit. So you had this real appetite for opportunities where the counterparty was off-chain, not connected with crypto, because they're going to be less correlated with crypto risk and crypto asset prices. And now we've kind of come full circle a bit in that with asset prices way up, people are very much interested in the more on-chain opportunities again. So I'd say in the space now, we have matured, so you have off-chain private credit, you have kind of on-chain private credit, which would be exchange OTC desks and market makers, and then you have off-chain public credit, which is T-bills, CLOs, investment grade, fixed income, and bonds, which is very popular for DAOs, being since they have a more conservative investment and treasury management profile.
Agree with a lot of that. You brought up some of the counterparty risks within specifically like FTX. Anthony, I know Trident Digital sort of works on fixing that and uses that as an example of how to build sort of the on and off chain merging. Could you explain sort of maybe some of the differences in how you guys handle counterparty risk?
Sure. So I don't think we're in a world where one, counterparty risk can be evaluated the way we did it in traditional finance, because outside of Coinbase and Galaxy, I don't believe anyone else is public. People have been audited and people do have some layers of regulation, but it's really hard to do true due diligence on someone who's not regulated. And we saw that with Genesis, and they were audited, not regulated, and in the end, we saw what happened. So, I struggle with the allocation of credit in the space under that standard. So the way that we're trying to do it at Trident is we're trying to lend tokens via a oversecured model where the borrowers stay within our sub-accounts on exchange, and the lender has full visibility into who they're lending to and where their tokens are. And the kind of borrower puts up a first loss, which is really what the counterparty risk is going to evolve into. So the idea is that if you put up a first loss and you're able to margin call and liquidate within that first loss, then the actual borrower doesn't matter. Right now, we have to do a lot to prove ourselves that we can do that, and others can do that. But I think that's the way to take the market forward, because doing a mix of on-chain, off-chain credit analysis, I don't think that model's been built yet. It's definitely not in the TradFi space, and in the crypto space, I think there are many people attempting it. I just don't think we're there yet.
Yeah, there's a bit of credit analysis. I know the human team focuses specifically on that. So could you maybe explain a bit, just everyone says credit on chain is more transparent, maybe more risk averse. Could you sort of explain the process you guys use for building some of these new pools?
Yeah. Today, if you look at a lot of the on-chain private credit, the information you find is not really on-chain. The information you find is usually hidden behind the scenes, even if there's a pretty lengthy loan agreement and PPM. The risks involved is not very clear until actually you do a full cycle underwriting, but also utilize third parties to do ratings on this credit if the asset is large enough. So we do leverage all of those. We do leverage experts in underwriting to go full detailed DD on his assets, bring all the critical information, and we figure out basically what needs to be on-chain out of all of that and what needs to be keeping track of, both on-chain and off-chain, and then bring in the credible rating agencies or parties who can do that kind of work to provide third-party attestation to all of that information. And now we're also including some of the new partners who do auditing of assets off-chain to provide their auditing reports on-chain. In a way, the goal is to bring as much of that verification information, similar to like how proof of reserve kind of works, on-chain, so that the participants can utilize the information almost as it is money. The other part is we have to figure out eventually how to make these assets more liquid, because without assets being liquid, the information you get in terms of risk is not necessarily actionable. So those are things, in our opinion, go hand in hand. And the more liquid you can make those assets, the more useful the information you have on this site.
Herbal, do you mean by more liquid, you mean secondary markets? for the assets?
Doesn't have to be secondary markets, but that's definitely the holy grail of it. We're working on vehicles that can create 30-day callable options on some of these assets. Just because we focus on short-term receivables, we're able to do that, but not every private debt asset can be turned into that. That's the first step. Second step is creating liquid markets on the secondary side, and there are some interesting achievements happening, especially in Eastern markets. There are multiple RWA exchanges coming in with their own AMMs that can achieve some of this at a smaller scale, but as the market matures, we believe that secondary market will mature as well.
I think you bring up a really good point, because you could have all the transparency in the world on a loan. So if I lend money to you and then your financials start to deteriorate, it's great that I know I'm not going to get paid back, but it'd be nice to be able to sell it at a discount before that, right? Like, I mean, that's really the point you're trying to make. Like, because if you don't have an intermediate liquidity event, then you're basically just investing and hoping to get your money back. And I think the problem that we face in this space is people who can invest and hope to get their money back plus a multiple are typically VCs, which means that they need 10x, not 10%, right? So we have to design the product for the clients that would invest that way, and I think you make a great point about liquidity.
We're going to get very into liquidity here. We have 35 minutes, so I will ask some hopefully heated questions there. Before we get into some of the deeper things, I have a question for Chris from Plume. So we say RWAs. I sort of hate the term because it doesn't mean anything. I guess we can talk about public credit, we can talk about private credit, we can talk about real estate. Chris, what sort of things are people building on your guys' RWA L2? As Sydney was saying, really the ecosystem started as high-risk private credit, has moved into public credit. What are you sort of seeing now with what people are launching?
Yeah, totally. I mean, I think, like you said, I hate the word RWA, and it's always funny how quickly we ruin these three-letter acronyms, and they just become fucking meaningless, right? So I think that's largely like my take on it, which is RWAs means nothing today, but really our view is RWAs touch or anything that touch the real world, right? And to me, that is broader than I think a lot of people think about, maybe public credit and private credit. And these are huge categories. I think they're very real and good to have on chain. But, in our perspective, at the end of the day, what I care about and what we care about is like money, volume, and users and people doing things on chain. And that spans a bunch of categories when you're talking about maybe collectibles or alternative assets, right? Or financial instruments or whatever it is, right? So for us, we've got, over 50 protocols building on today across all of these things. And, our perspective is let's keep it open. I think there's movement in all of these areas and there's different markets for each of these, right? Some of these are taking off-chain people today, putting them on. Some of them are taking on-chain people and giving them other things to do, right? And so it's all of those things today. And also maybe one thing to add is, a lot of people think about RWAs today in the idea of like tokenizing something and putting it on chain, which is very real, and I think it's a thing that makes sense, and there's a lot of benefits to that, obviously. A lot of these things also, like if you think about things from like a crypto native perspective too, a lot of the stuff is sort of like spot markets can be thin, but if you do derivatives on top and perps and things like that, that can be it. So a lot of things that we see are also taking, there's no tokenization. It may be, synthetics or price feeds or things like that and be able to build tools on top. And so, we sort of see the world as like, there's a lot of, RWAs today is a lot of, in my opinion, off-chain stuff coming on, right? Or at least taking on-chain money and putting it off-chain, which is great, and I think there's a very real need for that. And our whole view is let's combine that with a lot of crypto-native elements and things that apply to a crypto-native audience and find the right products and the right types of assets that can thread the needle between both those things, right? And it's a lot of things you guys talk about, which is finding, like, building liquidity in there, making things more transparent. And if you think about things like risk and how to do diligence, a lot of it is like, what do you do in the real world, and how do we put that on chain? And I think there's a lot of interesting areas where you can take specific things that are specific to crypto, right, and make that unique. So, for example, we're partnered with, with like a big fund that does a lot of solar farms and tokenization around that, right? So, classic diligence is let's take the data room, the PPM, all those things, and throw it on chain so you can see it and track it. But a more crypto-native aspect would also be let's take a feed of what the electricity is being generated on a daily basis, throw that on chain so you can kind of see what's happening, map that to what you're getting paid on regularly. So, there's a lot of those types of things as well that I think are important. So, it's all of these things today, and I think it's a lot of what you guys have done. I think you guys have like paved a lot of it, and then I think if we can introduce all kinds of new things, mix and match them together, where both crypto native assets, but also a lot of the RWAs can like live and work together in a more composable, interoperable way. Like to me, that's like the idea of where we want to go and how we want to take things.
So there was one thing you said where, it's more than just putting real world assets on chain, but And I agree with that. And I actually think that sometimes as a group we kind of minimize getting that stuff on chain, because it was less than 50 years ago that if you bought a US Treasury bond, and Treasury bonds pay coupon twice a year, that you physically needed to go to the Treasury window and get your money, right? That we used to have, and I haven't, not 50 years old, but when I worked at banks where you have runners who went probably in the 70s, maybe even in the 80s, who would have to go to the Treasury window to actually deliver bonds and take coupons.
They still do that today. There's still physical settlement, and they send people out on bicycles. And
Right. So when they eventually said, let's just get this on computers, right? Everyone, I think the initial reaction was like, who cares? But I actually it allowed a lot of a bigger innovation. So like, there's a lot of great stuff we're doing, but I wouldn't minimize, and I wasn't say you were, but I'd say I wouldn't minimize the getting that, tokenizing all these assets so that they can live there.
Well, totally. I mean, that's the foundational piece. You have to tokenize a bunch of the stuff in order to even get on there, and then you can build other stuff on top. But without it, there's nothing to do, right? So you have to build this stuff, and that's where a lot of the work today, and like a lot of things I think Maker's done has like done a great job of, is like, it's a combination of a bunch of the tech, but also there's a bunch of legal stuff to do and a lot of structure stuff to figure out that's very complicated. So, so yeah, no, I agree. I think that's the foundational piece of it all.
We mentioned some of those categories. To me, where crypto provides value is probably that 24/7 capability instead of walking to a physical bank teller. We're sort of now instant settlement, flash loans, things like that. Do you guys have any opinions on things like commodities coming on chain, forex coming on chain, metals, obviously markets that are very liquid, off chain, not so much on chain? So does anybody have, 5 of us here, anybody have an opinion on some of those RWA categories?
I think they'll come on chain, but the issue is the demand side. There's nobody with money on chain who kind of wants those things. There's a ton of people who have those assets off chain, or they trade them off chain, and they kind of want more distribution. And the view is that retail on chain buyers will start trading them if they put it on chain. And so it's the issue is on the demand side of that equation, not on the supply side. And they're already trading the guys who already trade it, who are experienced in trading commodities, for example, already have like plenty of venues they can go to access it, and access to leverage, which is how they kind of generate the outsized returns that they need to.
Yeah, I agree. I think look, if we're going to bring things on chain, it's a lot of people sort of oversimplify it, and not saying that we are, but like, let's just take XYZ thing in the real world. Now we do it on chain. It's awesome, And most of that is bullshit, because like at the end of the day, it's like going to happen, but it just takes time, and it's more about what order it happens and how this actually manifests. And so I think, like you said, what's the value for bringing it on chain? Is there demand there, right? Are people actually going to do this, or is it just let's just take this and put it on chain? If there's nothing happening, it's not gonna happen, right? So I think the way to thread the needle is to find, again, like unique things that can be done better because it's on crypto versus just take XYZ. So I mean, but there's esoteric rules around commodities, right? Like there's a whole thing around onions where you can't really trade a lot of onions. So like maybe there are some sectors and some aces where like there's some unique aspect that allows it to come on. Otherwise, it just doesn't matter. And like it'll happen, but it'll take time. It's not the first thing to come in. There's no draw, right?
So I think that I think Sid said it perfectly. If you're thinking about RWAs from a distribution standpoint, totally agree. I think there's limited capacity. I think the people who need access to the market have it, and just tokenizing doesn't open up a big audience. I actually think tokenization's a massive opportunity from a settlement standpoint. So what I mean by that is that working for a bank for 20 years, every transaction settles T plus something. And what people don't maybe recognize is that every bank who does a trade with another bank has to put up a certain amount of capital against the settlement of that transaction, right? And they don't net. So if you sell 50 shares to 50 different counterparties of Google, you still have to capitalize each one of those trades. And the unlock is if tokenization leads to instantaneous or same-day settlement, the amount of capital that banks would have to post, and I'm not going to let kind of the facts get in the way of a good story, but let's say it's a significant amount. And that's how banks are evaluated, right? So most banks trade on their book value because their capital contribution is so high. If you decrease the denominator by say 10 or 20%, which I think is probably the number, maybe even as much as 30%, bank stocks which barely trade at book value can start trading at multiples. So you're talking about $1 trillion industry that can now trade at 2x. That's a massive opportunity, and I think that's the unlock from a settlement standpoint as opposed to maybe a distribution standpoint.
A huge part of, I think, overlap between what Sid has mentioned and Anthony has mentioned is that the demand will determine what kind of assets will be tokenized. And what we're seeing is, especially with the stable coins, exploding, and more frameworks trying to rush across the globe to bring local stable coins to the market, there's going to be a settlement requirement that will include an FX trade. Because a lot of times the monetary policies require a fully local trade to happen in the local currency. And that will only happen once there's actually an FX involved in that transaction. So we believe one of the first use cases we will see exploding throughout 2024-25, on the tailwinds of all these different stable coins coming to market is going to be the FX markets actually coming as part of the RWA and creating a lot of yield opportunities because in majority of the global settlement transactions, FX determines the margin. And that will become basically a yield generating factor for a lot of RWA assets that we don't have yet, but we'll have very soon.
Yeah, I think to that point, I mean, a lot of tokenization RWAs today focus on sort of bottom, or like, let's call it like back office or like, improvements to, the opposite side of things, right? So maybe, again, like I think settlement's a good one. I think a lot of people know like fund management's easier on chain and all these things, right? Distribution. So all those things are great, but ultimately, like at the end of the day, it's very simple. Economics drive behavior, right? And so about making money is like what brings people in. And so finding products and things like that really drive people in, or new ways to make money or new yield opportunities, like you mentioned, right? I think that's what really comes into play. So it's about combining both, right? They don't live without each other. So it's about making this interplay. But ultimately, I think finding other ways or new products or new avenues where people can really capitalize on a new way to make money or some new edge or alpha, that's going to bring that new stuff in, and that's how we grow this whole thing.
Yeah, I think that speaks to kind of where we are in the RWA development cycle. I think the first step is just taking traditional financial assets and putting them in a box and then issuing a token against the box. There's nothing particularly natively digital to those things, but you're allowing on-chain capital to go off-chain, which is super important. So as the market develops, more parts of the financial plumbing can come on chain, and you can bring on custodians and banks and trustees and fund administrators, and all their services can be integrated into an on-chain world. That's where you start to see the utility develop and provide a compelling reason to bring people in and create that demand side, which will drive the further innovation.
100%.
I'm glad we're talking about the demand side. When tokenization theme was so important, maybe 5 or so years ago, I think a lot of people were saying the whole real estate market was going to be on-chain by now. And obviously, that hasn't happened. I think one of the main reasons, and it's what we've talked about, and we have plenty of time to get into it, is just the liquidity of all of these assets. Wrapping some of these assets on-chain, having liquidity off-chain. We mentioned secondary markets. Sid, you may have good insight into this in particular. What is the value of some of these secondary markets? How hard is it to build out liquidity? And sort of what's the difference between that and the T+2, T+3 settlement we're used to?
With the secondary markets? The biggest issue we've seen with the secondary markets is they only solve a one-way problem, which is you hold an asset and you want to get out of it. Most of the pools that are on chain today, whether it's Maple, Centrifuge, Humor, Goldfinch, you can actually mint into the pools at any time. So therefore, the demand side of your secondary market has a problem, which is somebody doesn't need to buy the token on a secondary market because they can just go and deposit into the pool at par. So the only use case then is like you want to get out of that because you think something's wrong with the pool, or you want liquidity early, which means you're naturally going to look at taking a loss. So it's hard to then go and make a profit on these pools, which limits the appetite for them. I think if you were doing closed vintages where you said, hey, this is the Maple or the Humor 2024 pool, and people can go in for 3 months, and then we're gonna originate loans, trade credit, and it will generate a return. But from there, then a secondary market is available for anyone who passes KYC. Then you could have a proper secondary market because you have an off-the-run issuance that people can trade and it can fluctuate in value. But at the moment, the only use case for the secondary market is to get out of an exposure that you think is kind of impaired.
So this is an interesting topic, and I think it's approached, I feel like crypto is very much equity driven as opposed to market, like a lot more equity, ex-equity people here than credit or rates. But the way traditional bond markets work, and that's what these pools are most equivalent to, is the market makers and the issuers have a partnership. So the market makers, so if IBM issues a bond, they hire 3 market makers. Those 3 market makers get a percentage of the bond fees from issuance. Yeah. So I'm not sure if this incentivization scheme exists in crypto, but I think that having market makers that are paid riskless amounts of money to market make the pool, at least initially, will create that secondary demand. But I haven't been that close to it.
Yeah, I think that could happen. But the other issue is that in that equivalent example, IBM can go and issue new bonds anytime you walk up to the desk and say, hey, can I have some more? Which kind of limits the use case of buying on the secondary market.
True, but all of these issuers issue bonds, every week, every month, and there's always a demand for. There's always market makers in the space. That's what we all did for so many years, right? So that still exists. There's a reason to own a bond that matures in a year as opposed to one in 6 months and 3 months. It's all also about building demand. Incentivizing a market maker to market maker pools is only step 1, right? It's about building that next layer of distribution of who would buy a pool in the secondary market versus origination, right? So that's how you start to build a multi-tier liquidity. But I think you guys who are issuing, it's really the next stage, because just hoping that some secondary person might want to buy it, and I'm sure there are at a 50% discount or 80% discount,
Yeah,
but like how do you get it at 2 or 3%?
Yeah. I think that market will start to evolve, because you already see a bunch of yield-bearing stablecoins now, which you can think of are intended to be kind of like a low-risk fixed income instrument, and some of the market makers are looking to market make the yield-bearing stablecoins. And so then it's the next logical step is, could they market make an instrument that has like a higher yield, like it is investment grade, and then you go, high yield junk, something else. But you're starting to build a yield curve from the lowest risk thing being a yield-bearing stablecoin that's backed by treasuries. And if we have market makers who are willing to do this kind of pure fixed income stuff, instead of only doing like spot tokens or token perps, then we can start to build more of a fixed income market on chain and have proper dedicated issuers and desks who are issuing like bonds and things on chain.
I think the roadblock for that thus far has just been the opaqueness of credit ratings and getting people that understand, like you said, the credit side as well as the crypto side. For example, I remember S&P Global maybe 2 years ago, they came out with a rating on Compound as like a C or B minus, something like that. How do we get those type of actors to come on chain and sort of give these credit ratings to all the way down the line of the yield curve, from public credit to private credit to junk bonds, all that?
S&P actually recently released some stablecoin ratings, probably about a couple months ago, and they weren't its traditional AAA to double C rating system, but they assigned something like a 1 through 5 value. So I think they're starting to poke around and seeing that there's interest. You see services like Blue Chip come up, and where they're clearly satisfying some demand for people who don't want to do the full due diligence or can't do the full due diligence and want to defer to a service. So I think we're starting to see that. I think it's super useful for those broadly traded and largely adopted stablecoins for people to have more information. That's kind of Steakhouse's mission statement, is to create a more open and transparent financial system. So anything that we see to that effect, I think, does a lot of good for crypto as a whole.
I think the one challenge that we have with these ratings is, in the traditional world, something that gets a AAA rating has a ton of capital sitting behind it, right? Like reserve capital, depending on what type of structure you are. If we were to do this in this space, we'd make no money, right? So we're kind of a little bit too immature as an industry to get those higher ratings based on the way they're going to look at us, unless we're massively over collateralized and thus not making a bunch of money, at least initially. And I think that's kind of the rub for us, is to get, we want those ratings, we want to do business the same way we're doing business.
Yeah, and S&P when they announced this project with stablecoin stability report and transparency report, they said it's actually very hard for them to issue ratings even for stablecoins. They are the largest cap RWA products, as you may say, on the market, and even then S&P doesn't want to put their reputation, on the line to actually rate them. It's going to take much more and many more years for them to actually be willing to do that. I think, solution to that is that we have to have alternatives to S&P, and those alternatives need to prove their credibility in terms of ratings. But even then, I don't think we'll be achieving much. To Anthony's point, what we believe is it's critical to get traditional finance to put their capital into this. If you think about private debt only, there's about a $1.5 trillion market in traditional finance, and that's where the buyer's market is today. There's almost a starter buyer's market on chain, and a lot of people are trying to bring those traditional buyers into the on-chain markets. One model that we are very excited about, that we have seen that might work, that we're seeing funds, alternative asset management funds, coming out that are fully licensed, regulated, and they can issue exchange tradable products, ETPs, that can invest in on-chain assets. So this can actually be the funds that can go and attract capital from traditional finance, utilizing a very high transparent PPM and risk analysis, even get alternative rating agencies to actually provide those ratings. But then the capital can be deployed on-chain through these fund managers, and they can manage all of that on-chain. And I think that might be one way we get through this liquidity crisis, by bringing that buyer side at a larger level on-chain, and have basically more of a market for these buyers to care about what's happening to their assets, and find that the secondary markets can be even more lucrative on-chain.
I think that's a phenomenal point, because think about when the ESG market started. The BlackRocks and the PIMCOs of the world were like, sure, I'll buy an ESG bond cheap to a government bond or an agency bond. And then eventually they raised funds for ESG funds, and then the amount of money that went to ESG products forced those bonds to trade even richer than some government bonds. So I think that's what you were saying, and I think you're 100% right.
I'm glad you brought up the ETP example, bring sort of the on-chain, off-chain. As we said, demand is the most important piece of all this. It seems like that hasn't really been the trend thus far. It seems like, for example, Franklin Templeton bringing their money market fund that's off-chain, bringing that on-chain, looking for demand there. PayPal using their fintech app to bring a stablecoin on-chain. What do you think some examples of on-chain now to off-chain like ETP products will be?
What do you mean on-chain to off-chain?
So he took the example of you have maybe Oracle's on-chain, you have products on-chain that are now being wrapped for traditional finance. What do you guys think examples of that will be? Because as I said, it seems right now the trend has been bringing off-chain assets on-chain.
I think you'll have on-chain forms of credit. Like there was a lot of lending, Trident is doing this as well, but there was a lot of lending to OTC desks, market makers, and exchanges. That was the biggest form of credit in the 2021-2022 cycle. And that's something that traditional asset managers can't get off-chain. Whereas the issue when you've been trying to sell stuff to off-chain people before has been they just say, well, I can go get this from Morgan Stanley anyway. And so here, if you could set up an off-chain fund and then have it deploy into over-collateralized strategies or strategies where you have layer ones, like let's say Sol, AVAX, or Ethereum BTC posts as collateral. That's a unique offering that I think a lot of off-chain investors will buy this cycle as Bitcoin keeps rising and general prices bring more eyeballs to the space. So I'd say that's a unique asset. It's higher return than what you can get. And so there's the possibility for those massive managers to earn outsized fees by offering that product to off-chain investors.
Yeah, we're mostly in a transitionary market where the macro in traditional finance is still seeking, SOFR plus rates for everything they do. And we know that's going to start to come down. And when that starts to come down with enough assets that, attract quality investors, I think we will see the transition happen a bit more rapidly. Right now, there is little financial incentive for the transition to happen very rapidly, especially when you use examples of Franklin Templeton, where majority of their investor base is still very traditional minded, right? There might be a group in the company that's putting certain things tokenized on chain, but if you look at the communications they do as an organization, you will have a hard time finding those opportunities in their general communications that they do to their investor base. With better regulations coming,
been brought up a lot today has been credit on chain. There have been a few examples of defaults on chain. I was hoping someone here could sort of explain how some of those processes have gone, how that's different than some of the off-chain private credit, and in particular, how are liquidations managed, things like that. I'm not sure if Sid or Human Team have any comments.
It depends on how the loan was structured. So if it was a over collateralized or asset secured by crypto, then the liquidation. So what's going to happen is the asset's going to decline in value, or the borrower is going to miss a payment, and then you're going to hit a liquidation level, which is set at a protective buffer, and then you're going to either send the asset to a DEX if you're a pure on-chain protocol, or you're going to have keepers buy it. Just the other way of doing it, kind of purely on-chain. Keepers would be, whitelisted buyers. Or you're going to send it to an OTC desk if you're doing it in more of the centralized or CDFI kind of way, and you send it to, a GSR or Wintermute or a Cumberland or one of these prominent market makers to get a good price on it. If it's unsecured, then you go through a conventional kind of bankruptcy process, which is basically the same as what happens off-chain. You prove that this person owed you money, and then you appoint a liquidator, and then it becomes a very, very time-consuming and costly process for creditors to get their funds back. But basically that liquidator is going to take everything the borrower owned, sell it, and then apportion it out to employees, creditors, and anyone else, vendors who might have been owed money. But that process can take more than 12 months. And we're seeing variations of these processes with some of the CeFi bankruptcies, the CeFi lenders. And we also have seen close calls on chain or visible examples where 3AC was getting liquidated on, I think it was Aave and Compound. But there are also near examples like the recent sort of Curve episode with Aave and some of the other lending protocols. So the risks, the way that things play out is different between on-chain and off-chain, but the fundamental risks are the same.
I would just add to that I would say the risks that were the known knowns and the known unknowns, right? And then the ones that were just completely mismanaged. I think the biggest risk that was completely mismanaged was taking things as collateral that should not have been collateral, like borrowing from Alameda or lending to Alameda back to an FTT, right? That kind of wrong way risk, I would say, was one that was avoidable. I also think lending to emerging markets where the loan assets in dollars and they're using them in other countries where most currencies have depreciated 50% or more against the dollar in the last year. So I think, I won't name the protocol, lent to a company in Nigeria. The Nigerian local currency depreciated by 60%. So what that means is that loan is doubled. So that unless they double their business, they can't pay those loans back. And these kind of providers of EM loans don't have access to hedge the foreign exchange exposure, right? So I think those are two big avoidable ones. But I will say, I think there's a lot of people who got a bad rap in this last cycle because the CMO housing market debacle happened the same exact way. The market went euphoric. We couldn't print enough loans to feed the CMO and CLO machines. The standards dropped to meet the demand on the buy side. And then eventually it led us into risk management that blew it all up. So I don't see it to be that much different. And I can say there was a hell of a lot more CFAs and CPAs and doctors managing that risk process than there was managing ours.
I think that what you said around the emerging market stuff is a good point. I mean, you just look at a lot of like what happened. I think people are just chasing yield, right? So hey, let's go to emerging market and find some place and lend against this thing. But it turns out like diligencing like a Vietnamese auto shop is like hard in real life or on chain. It's the same shit. You know, it's hard anyway. And so like when that blows up, it's the same process and the same problem. And so I feel like there's you know, if you're bringing stuff on chain or finding a way to do that, finding a way to make sure that you thread the needle of like what are the benefits of doing it on chain versus not are important. And so in that case, like some of these products, while the yield is better, it's like all the other pieces around it just don't, right? It's heavy lockups or hard or whatever. So it's like very tough to assess the risk there. And so again, it goes back to the point of like, how do you find the right assets and find the right products that actually mimic the type of experience that people want on chain, or something that's off chain, like you said earlier, right? How do you bring these new products to folks that are off chain to actually make sure there's an interesting asset for them, right? That they actually want to buy. So I think that's the main thing. It's just I think 99% of the risk stuff is just, you know, and it's probably oversimplification, but it's asset selection. It's just making sure you're picking the right ones, right? And doing that in a way that is, again, I think it's a narrower window than we'd like to think in reality. That sort of is between crypto and the trad world, right? But finding the assets that fit that, I think, are the best way to do it. And then, of course, you build all the scaffolding around it to make sure it's safe and sound and do everything there. But if it's fundamentally not a good asset, and sure, you get 15%, and you know, but like we don't know what the hell it is, it still goes to shit, you know.
Yeah, I think when I look at those early defaults from these, you know, first generation RWA protocols, I kind of think of those as growing pains because I think the technology got a little bit ahead of the, you know, fundamental financial work. I think there's no crypto futurist substitution for trying to figure out if a borrower is going to take your money and not give it back. So that work still needs to be done, and it doesn't get any easier because you put some things on a blockchain. So that absolutely has to be done. And also, perhaps the protocols suffered from, as a result of that, they suffered from negative selection to some degree. So right. Borrowers knew that the credit underwriting wouldn't be as strong as in traditional markets, and they saw an opportunity to get an advantageous loan agreement in place. And unfortunately, some of the lenders, you know, suffered as a result. But, you know, from a total market perspective, I think it was relatively small, and you know, the RWA providers they learned their lesson from those things and look to the future to improve that process.
Yeah, totally. And you see this already today. Like a lot of these products, like one, again, like you said, the size was not massive. So I don't think it's like, again, this shit happens. It's not like horrible, and it goes up and goes down, and some things don't come back. But like you said, I think if you look at sort of a lot of the stuff where market makers are coming in today, or there's activity, right? It's these interesting, you know, sort of fixed income type stuff, right? Like that's a great way to bring people in that has, again, threads the needle of both what happened in the real world and not. And it's again, there's like lower risk there. There's a lot of like good things around that, a lot of like good features that make it more amenable to, I think, bring in a lot of new stuff, both off chain and on chain money and attention. So makes sense.
As a quick closing statement, would love to hear from each of you where you see the RWA space in maybe a year from now. We can talk about different collateral types. We can talk about maybe different TVL projections, but start with you, Anthony.
I'll keep it quick. I think we didn't get to talk much about this, but I think we'll probably see a major blow up in a yield-bearing stablecoin if it gets to scale. And I think the probably most innovative thing I would see coming is, and I think you guys alluded to it earlier, is a FX, tokenized FX, because it's really hard as an American to buy Brazilian reais or South African rand because they're non-deliverable currencies, and then attaching them to their local yield. So I think that's an innovation that the market kind of wants and needs.
I think hard to make a full TVL projection. I think we're still continuing to see appetite from startup treasuries and DAO treasuries for the lower risk yields from T-bills. So I think within the RWA space, I do think that'll continue to still be the category that experiences growth, even though it's been kind of flatter since January. But I do think you'll see a return of a lot of the types of lending that were done in 2021 and 2022, though. So we're seeing a ton of appetite from, you know, the old market makers who were borrowing then. So I think that'll actually probably hockey stick in growth this year.
Yeah, I don't have a specific projection, but definitely up. And I think that'll be aided by continuous institutions continuing to come and provide new products to the market. I think we've only seen the first wave of that, and as these new institutions bring products over the coming years, it's going to lend further legitimacy to the space, and more people will tag along for fear of missing out. So, in a year or two, I don't know if that's enough time, but 5 to 10 years, I think we can see an exponential growth.
5 to 10 years. Wow.
I hope we'll see $1 trillion in stablecoins this cycle.
definitely excited about the booming of stablecoins, which we believe is going to increase the adoption of global settlement liquidity solutions and assets around that, which will also create a larger FX market, and we will see a boom in that. Also, ETPs, I think, is incentivizing more and more asset managers to look into alternative type of funds where they can earn higher because the fund costs are small and efficiency is much higher, utilizing ETPs that can actually trade on chain. All of those we believe is going to create another $50 to $100 billion of at least transactions on chain this year.
Yeah, maybe I would say I'm like, obviously, I think I'm obviously bullish RWAs and where things are going. I'm probably like, I think the general sort of CT narrative or like, a sentiment on RWAs, I'm probably less bullish on. I think it's going to happen. It's going to take time though. Like at least everything I see is like, we're still building a lot of the sort of foundational pieces. I think a lot of the pieces that are being built now, I think are very solid and like going to get mixed in very interesting ways that could lead to a lot of growth. But it's going to take time. I think we're laying bricks for the next 1-2 years, and there's going to be growth that comes as a result of that. I mean, we see the inflows already. I mean, shit's going nuclear every day, right? So that's great. And so you're seeing that come in, and the attention's going to come on the back of that. But it's bringing new things on. It takes time, and it's matriculating. But I think if you sort of think of it in stages, we were in a very like you said, early experimental stage. Some shit works, some doesn't, but it's like growing. And now I think a lot of the core piece and a lot of the great work that you guys have done over the last few years are really taking hold, and you're seeing these products really have a lot of interest from both TradFi folks, but a lot of crypto natives. And to me, that's the magic, and that'll be a great foundational block for us doing a lot more here. And that's going to trickle in over the next 1-2 years. And I think right after that, like you said, maybe not right after, but we have a couple things on the horizon, right? We've got a big election coming up. That's going to that's definitely in people's minds, and it's going to slow things down. We're going to have to see how things play out, right? So there's a bunch of things happening there that are going to sort of keep us excited, but with kind of guardrails around it, and then allow space to innovate and create. And once that happens and things change there, then I think we'll go nuclear. So it will take time, but I think right now is a great time for everybody here, and great foundational time to really get in here.
Agreed. Certainly lots left to build. Glad the real-world asset ecosystem is growing. Hopefully this time next year we'll have some more to talk about. So thank you all the panelists. Thanks everybody.